In this short video, we'll look at one of the most significant changes to buy-to-lets, its implications for contractors and the solutions available to ensure that the impact to our clients are minimised. One of the reasons why buy-to-let's been such a popular investment for contractors is the unique way in which they're taxed. Currently, landlords can claim tax relief on their mortgage interest payments at their marginal rate of income tax. This means that a basic rate taxpayer benefits from 20% tax relief, and those who pay higher or additional rate tax benefit from 40 and 45% tax relief respectively. Income tax is only paid on the rental income less mortgage interest payments. Let's say you own a property worth $200,000 and have a mortgage of $150,000 with a monthly rental income of £800. Under the current tax rules, you'd expect to have a net profit of £2,160 at the end of the year. Not a bad return on your investment. So what can landlords do to minimise the impact on their new purchases and existing portfolio? Well, thankfully there are a number of things you can do to lessen or even potentially remove the impact of these changes altogether. The first and simplest thing to do is review your current mortgage arrangements. This might sound an overly simplistic solution to what seems a complicated tax conundrum, but consider this: the higher your mortgage interest payments are, the greater you'll be affected by these tax changes. Simply switching mortgage deals could save you a heap of tax and cut your finance costs at the same time. If your husband or wife isn't working or is within their basic rate tax band, you could transfer ownership of the property to them, provided this doesn't push them into the high rate tax band. This needs careful consideration and execution, as your spouse may not be able to demonstrate the minimum level of earned income required by many lenders, and there can be tax implications and additional costs along the way, particularly if you get it wrong. By far the most popular solution, it seems, are company buy-to-lets. Limited companies aren't affected by these changes and benefit from paying corporation tax, which is half the rate of high rate income tax. This could be a great option if you don't need the income from your property right now, and perhaps can build a nest egg within the company vehicle until such time as you retire or decide to spend it. Company buy-to-lets can be complicated to set up, but needn't be any more complicated to run than a personally owned buy-to-let. You'll need a new limited company to own the property, and it's worth discussing this with your mortgage advisor and accountant in the first instance to ensure that the structure and relevant paperwork meets the lender's needs, as well as your own. It's also worth noting that where you have retained income in your limited company, sat gathering dust in your reserve account, we can often arrange with the help of your accountant for those funds to be used as a deposit for any new purchase without the need for you to draw additional dividends. That could result in a considerable saving on the upfront purchasing costs. So if you're purchasing a buy-to-let through a company, you continue to benefit from full tax relief on your mortgage interest payments, pay less tax on the profits thanks to corporation tax, and could even use this as a way to invest cash locked in your limited company. So what's the catch? Well, there isn't one. Historically, lenders have charged a higher rate of interest on these types of mortgages. However, we've seen a rise in the number of lenders offering mortgages for company buy-to-lets. And as a result of that competition, the difference between a conventional mortgage and a buy-to-let loan is minimal and more than covered by the tax savings. If you'd like more information or want to discuss your requirements with one of our specialist mortgage consultants, click on the link at the end of this video. Thank you for watching.